You to our new venue if you've not been here already. So we had one talk before. Just to give you a clue about upcoming events, we've got a talk from Mathematica on the 21st of May. On the 4th of June we've got a high frequency trading panel, and Anna Reitman is actually going to chair that panel. And we've got a stellar cast of panellists, including Chaim Bodek, who's actually going to dial in from the US, who's pretty well known, and thanks for Anna for organising that. I'll also be on the panel as well, but you know. And then on the 18th of June, we've got George Cooper, who's a well-known financial writer as well. And we're going to be starting that one slightly early before the football, so you won't miss out on the football if you come to our talk. And they'll be doing the football downstairs as well. I'd like to introduce, obviously, Iain Clark, who I'm sure you all know. He's a very successful author of 2 excellent books, which I implore you to buy. So, just trying to... Okay, I'm trying
no,
to
it's good. In fact,
well,
what I'm going to pass some of these around for people to have a look at.
Anybody wants to have a look at?
Let me start with these at the back. I'm hoping that people have already seen them, and if you pass them towards the front, then I can make sure I get them back.
Iain will also be selling books
and
today, and also signing them.
Those people who decide they would like their own copy.
And I've also got the first ever Thalesians flyer, so if anybody wants to be part of history and get the first Thalesian flyer, then please get. I actually just got them printed today, so they just say a bit about what we do, about the seminars, and also about the other stuff that we're starting to do in terms of publishing research and also consulting in terms of systematic trading. So please get a piece of history. I'm not become a salesman, by the way. Please, Iain, please.
Right. Well, thanks to everyone for coming to what is, to all intents and purposes, a book launch for this second book of mine on commodity option pricing. Rather than go too much into the advertising, the marketing side of things, you know, I can do some kind of sale things. I prefer to do quant and mathematical work. I thought I'd give a talk which I would hope would be of interest both to people on the commodities, but also on the FX side, but also provides some introduction to some of the material discussed in the book in chapter 7 on electricity. And I chose electricity as a particular example because it's one of the asset classes which has a bit of a reputation for being a very difficult asset class to model, largely because of the difficulties in storing electricity on any kind of industrial scale, which you can't do, because if you try to store electricity in any large amounts, then it's likely to burn out any transmission systems that you have. It's very difficult to store electricity in amounts that are comparable to oil or gas amounts that are used on industrial scales, whereas in contrast you can have very large reserves, strategic reserves or business reserves of oil, gas or refined products such as petrol and diesel. Electricity you can't. And what this means is that electricity is a much more volatile asset class. One of the things you'll see in the talk is that the volatility that we see in electricity is quite sporadic. You have definite possibilities for very regular price activity in electricity, populated by periods of spiky behaviour and really quite excessive levels of volatility. Now, that's not, when I first saw that, I thought this isn't so different from some particular type of currency pairs, such as pegged currency pairs, which much of the time are in a state of very strict managed equilibrium, but occasionally the markets push these currency pairs out of the peg, out of particular controlled regimes. So I can certainly see a lot of similarities between the modelling efforts required for electricity and FX. And as someone who's had experience in both of these asset classes, he says, pointing at the marketing materials I have in front of me, this I thought would be a good topic for a talk which covers both areas. So let's get into the talk. Page down, how do we do that? It's this one here. Right. So to give the outline, what I'm going to be doing is I'm going to be illustrating various features of the electricity markets, and I'm going to be describing some features of similar markets from FX, speaking of pegged and quasi-pegged FX markets. I then want to talk about the modelling approaches that are used for electricity and FX markets. Broadly these fall into two types, two categories. We have the so-called reduced form models, which,
Will you be distributing the slides?
They'll be available on the webpage, and I'm having I have an email address at the back. I'm sure everyone can find me on LinkedIn or whatever. So if anyone has any problems getting the slides from the Thalesians webpage, just contact me directly. So slides definitely available.
Thanks.
Right, so we have the reduced form models. These are models for price behaviour, which will be quite clear to people who've had a background in mathematical finance, people who can write equations of the form dst equals blah 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 with a dwt, or possibly a dnt describing the possibility of either Brownian motion or Poisson jump processes driving the asset price process. So the first one is a jump diffusion type model. The second is a regime switching model, which is certainly used in certain FX models, such as uncertain volatility models, where we allow systems to have different volatility states. You see the same thing very much in electricity type modelling, in a particular type of model, these reduced form models. Finally, I want to describe something that's quite unusual and specific to electricity markets, structural models, and what the structural models do, and people who haven't spent a bit of time in commodities probably haven't seen these, is they take advantage of a lot of the information embedded in the merit order stack for electricity, which basically gives us some information about the supply curves for electricity, thought of as an economic good, which as a commodity of course it is, to allow us to build models based around publicly available supply information for electricity, which can be used to build models which are capable of describing spikes, and then obviously we have a conclusion. So, as I mentioned in the introduction to the talk, you can't physically locate electricity on an industrial scale, and you can't maintain inventories of it, unlike oil or gas or petrol or diesel. You have to deliver electricity into a network, and then you have to consume it at the same time. Not necessarily at the same place. So a large hotel like this, for example, obtains electricity from presumably the East London power grid, and then spends it on useful things like cooling, lighting, electrical activity. So you have continuous consumption and production of electricity on the industrial scale. The production has to be delivered into a transmission grid and has to exactly match the energy consumption. This is a non-trivial task, and transmission system operators who operate in all countries have to balance the supply and demand on a continuous basis. And what that does is it actually sets up the framework for the traded power markets, which I'm going to describe, and is strong motivation for the stochastic models that you would use for pricing electricity and derivatives upon electricity. So we can see evidence of the scale of the transmission grid networks. This is North America here from Bloomberg. You can see North American power lines in excess of 345,000 kilovolts, largely clustered around the east coast, definitely in the vicinity of the west coast, and pretty much across the entire North American continent. You can see some features of interest, such as this large grouping of power lines for delivery of hydropower from Quebec, Quebec being a leading hydro producer given the scale of the Canadian province and particular electricity production in that region down into the New England region. You also see evidence of various interchanges where electricity is traded, such as the California-Oregon border, and you have the PJM interchange, which is Pennsylvania, Jersey and Maryland. And the point about these different delivery balancing points is that many of the contracts are written with reference to various balancing points geographically. So you have a very strong reason to consider geography in pricing commodities, not just electricity of course, but certainly in electricity. I do of course discuss geographical considerations for other commodities in the book. Western Europe, we have a transmission grid network, a much denser transmission grid network than North America, not surprisingly given population density. What this chart shows is power transmission lines. The black ones which you see here are direct current transmission lines. The colour ones are alternating current for various voltages. The blue are the lower voltages, 220,000 to 300,000 kilovolts. So these are probably the more minor power lines. And as you get into red and purple, then you have higher voltage power lines which are capable of supplying greater amounts of power. So you can see more of the red ones, and there are a few of the purple ones. The black power lines are interesting because these are direct current as opposed to alternating current, and the reason for that is that in general alternating current is economically cheaper and more advantageous to transmit electricity across land, but what you need to do is you need to have a greater density of repeater stations and transformers as you move along the power grid, as you move along the network, looking at the various pylons and the infrastructure required, which is fine if you're building this on physical land in England, Spain, wherever, but you can't do it underwater. It's economically prohibitive to build these retransmission stations on the seabed, and as a result, for underwater transmission, mostly, not always, you certainly see an AC transmission conduit between England and France, but for long distances, the economics are strongly in favour of direct current transmission. So, we have to talk about the way electricity pricing works in order to have any chance of being able to price derivatives against electricity, because derivatives, financial derivatives, are with reference to tradable financial contracts. So what we have for electricity is, similarly to most commodities, we don't really have a direct spot contract. What we have is, we have some contracts that effectively work a bit like spot. The way this works, and this is kind of subtle, so I'm probably going to spend a little bit of time describing this, is we have two different markets. We have a real-time market, and then we have a day-ahead market. So the way this is set up is, if we imagine that's midnight, I'm basically trying to illustrate two physical days, calendar days, not business days. Electricity trades on Saturdays and Sundays just as much as it does for other days, because you wouldn't get fired if you turned off the electricity on Friday night. So if you imagine that you've got, say, a Wednesday and a Thursday, if you're at Wednesday just after midnight, so let's suppose we're Wednesday at 1:30 in the morning, then that means we have effectively short-term hourly electricity markets for all the rest of Wednesday, hour by hour, for delivery of electricity hour by hour, and all of Thursday. So the contracts for Wednesday are called the real-time contracts, the real-time market, and the day-ahead contracts, the DA ones, that's day-ahead, and those are for the subsequent calendar day. These day-ahead contracts actually trade in significantly, massively greater volume. And what this does is it lets power system operators and consumers, utility companies, effectively put in approximate, hopefully relatively exact, but approximate bids for supply and demand of electricity for the subsequent day. Though this may not actually correspond to exact supply and demand requirements on a particular day, because things happen. You might be here Wednesday, and by the time we get to Thursday, you're going to laugh at me, but there might be a heat wave or something like that there. So maybe not this time of year, but it could happen, right? Or maybe there'll be some kind of ice storm. Maybe there'll be a sudden demand for power for some reason. Or maybe there's some petrol strike. Maybe there's an electricity failure in the transmission grid. So maybe other participants are called upon to supply electricity once we move from Wednesday into Thursday, and these days here become the real-time market as we roll forward one day. So the point is that the day-ahead market allows market participants to put in supply and demand, to match supply and demand, to put in bids and offers for electricity one day ahead in the future, with the expectation that market supply and demand, once we get to that day, will be broadly in line with those bids. But the real-time market can be used, and is used, to exactly balance the supply and demand in the event that the physical and economic market differs from expectations. So it's quite a well thought out system, I think, and it's a system that seems to work well given the complexities of electricity as an asset class. Because the day-ahead predictions are on average reasonably good, that's why these day-ahead market prices totally dominate. The real-time market is really only called in when you have shocks in a system, some excess demand is required or some excess supply is required, which means that generally real-time prices, because they're effectively like distressed prices, tend to be quite a lot higher than day-ahead prices. So the day-ahead market actually works very much like a spot market. It's the market which is most liquid, and it's effectively for physical delivery into a transmission grid one day ahead. You can think of it as T+1 settlement if you like. These two markets, the real-time market and the day-ahead market, are kind of motivated by and strongly linked to three different types of physical production of electricity. There are three basic categories, which are described as either base load, mid-merit or peaking plant, which effectively correspond to load factors. Load factor being an indication of how much it's used. It's like if you're running a Windows computer and you're looking at the little chart that shows you the amount of CPU utilization. If you're really crunching a lot of numbers and that little chart goes all the way up to the top and maxes out, that's 100% load utilization. Whereas if you're just sitting around checking your email and doing a little bit of word processing, then it's probably fairly close to 0%, in which case you're running at load factors close to 0. Same for electricity generation. If you've got a power plant that's running with load factors in excess of 70%, that's effectively meaning that it's on most of the time, and that's called a base load plant. That means that basically it tends to be fuel types that can't be switched on and off easily, such as coal or nuclear power. Those are fuel categories which once you start up the power production, it's difficult to turn it on and off quickly. Nuclear power stations, you probably don't want to turn them on and off quickly. Coal, you need to get the coal production at a high enough temperature to be able to burn coal effectively for power generation. In contrast, there are other fuels, and commodities being very much real assets. We have to think of them both in terms of the financials, but also in terms of the actual physical practicalities. You have other types of fuel, such as gas, natural gas, which you can burn and then you can turn off the burners and turn them on again very quickly. So that means that a power plant like an open cycle gas turbine, which can be started up and shut down at short notice, is far more well suited to real-time markets, so that they can be called on to supply extra power, if required, almost hour by hour if necessary. So the gas turbines are examples of so-called peaking plants where the load factors are much smaller. They might be used less than 15% of the time. That means that when you're using these gas turbines, you'd probably be expecting to sell the electricity for a higher price, and you'll see that in one of my charts in the merit graph. So I've described, what have I described? Basic features of electricity generation in terms of 3 different types of power plants and how these naturally map to the 2 main electricity markets, the real-time and the day-ahead markets. We can start to have a look at some financial time series, such as typical time series for the day-ahead power price. This is for, let's see, this is for generic baseload United Kingdom. And I should have also mentioned, and I will go back to the slide, I should have mentioned that for these different markets, the real-time market, which is effectively 24 different types of contracts for supply of electricity in each of these hourly blocks. Some of these hourly blocks are regarded as peak, and some of them are regarded as off-peak. The classification into peak and off-peak varies from country to country, but it's generally something like about 5 AM to 10 PM or thereabouts. It will depend on the country. So you have a time series, and what we can see here is we have certainly some visual evidence of stochastic behaviour. It certainly doesn't look in any way deterministic, but it also certainly looks like we have certain episodes where we have rapid upward spikes. You don't see any downward spikes. You never really see electricity make these downward excursions to the same level as the upward excursions. You sometimes see a bit of a spike followed by a rapid correction and even overcorrection, but you don't really see any evidence of the asset class going on like this and then suddenly the price collapsing. It does seem to be visually, I would say, one-sided spiky behaviour mostly. What I can do is and there are various heuristic ways to do this. I wouldn't say there's a huge science around this, but you can take a time series and you can try to identify periods in the market where you have spikes, and you can try to apply some de-spiking methodology, which effectively involves looking at the time signalling consideration together with some filtering techniques. And once you de-spike your electricity time series, you see in the blue chart something that probably looks a lot more like an asset price, a stochastic asset price process that might be more recognisable from other asset classes. That begins to look a bit more regular. As well as the spot, electricity spot, and I'm using the day-ahead prices as a proxy for spot. It's the closest thing you're going to find to a spot price index for this particular commodity. We have forwards. I've taken this chart from Peter Leone's presentation, who actually is writing quite a good book coming out through Palgrave Macmillan, which I've been asked to have a look at this week, so I'm going to to put a mention in for Peter. He's a good guy, he knows a lot about electricity, and I'm looking forward to his book, as I am looking forward to all the Palgrave books which are coming up this year. And a lot of people have been very busy, and I encourage people to support their efforts. It's hard work writing books. I wouldn't necessarily recommend people go into it naively, put it that way, but there is light at the end of the tunnel, for all of us, hopefully. Electricity forwards. You can see that we have the possibility to supply electricity, not just by hour, but also quarter by quarter, month by month, and year by year. What these graphs correspond to is the price to supply electricity for longer durations. So let's start at the back end. What this line here shows is that if I have a forward contract to supply electricity for all of 2015, meaning I have to supply a certain amount of electricity hour by hour, day by day, month by month, week by week, for all of that period, then the price I would contract to do so is something like about 50.5 euros per megawatt hour. Contracts for 2014 and 2013 are slightly cheaper, but I can break this down. I can say that if I'm supplying electricity for all of 2013 at about 50.8 euros per megawatt hour, I could say, well, I only want electricity for the winter months. You know, what's your price for the first quarter of the year? And then the price actually is much higher, 54.5. The price for the second quarter of the year is 45. Price for the third quarter is 46, and the price for the fourth quarter is 54.8 or thereabouts. So you can see that you can get some extra granularity in the prices for electricity forward contracts if you're working at shorter periods of delivery. And this, I mean, perhaps people have a pretty good idea of why it's more expensive for the first quarter and the fourth quarter. It's evidence of seasonality. It's because in these months here, you're centred around winter, whereas these two ones are centred around summer. So this is evidence of seasonality in the forward curve. We also have shorter durations here for various weeks, weekends, and individual days ahead. So you have quite a lot of structure in the forward market for electricity. FX. FX, on the other hand, doesn't. You have forwards, you have futures. I'm looking at them at the moment actually, but FX trades primarily as a spot-driven market, where the forwards are heavily driven by spot and interest rate dynamics. Now, this isn't an FX talk, thank you. This isn't an FX talk, but I do want to talk about specific types of FX processes, FX asset classes, which is, let's take Euro Swiss, dollar Hong Kong, and dollar Chinese renminbi as examples, which are notable for being controlled markets. Euro Swiss, we have the Swiss National Bank's defence level at 120. Dollar Hong Kong has a currency board which manages the currency according to the desires of the Hong Kong Monetary Authority to ensure price stability. Dollar CNY is linked to a currency basket, and dollar Turkish has had evidence of sovereign linkage in the past. So if you remember the electricity spot time series I showed earlier, and if you look at some of these FX series, then you can see that they have some similarities. They're not the same, by no means are the same, but I want to compare and contrast the sort of spiky behaviour you see in these animals coming out of the FX world compared with electricity. So this is dollar Turkey, and you can see here we have very low levels of volatility within this particular managed region, and then we have a deval event on the 22nd of February 2001, which is a big spike followed by a much greater region of volatility. So we can see the historical volatility in this market regime is quite small. There is some evidence, but really not much at all. Whereas in contrast, this region, after the devaluation, the realised volatility is much higher. For dollar Turkey. For dollar Chinese yuan, you see something even more extreme. We see this pegged currency up to this point here, and then with the CNY reval in July 2005, we had this big spike in downward direction, followed by an increase in volatility from practically zero to a measurable but small level. And I could come up with other examples as well. So if we're looking to build models based around trying to describe these spikes, there are these two approaches which are generally used in the literature. Most of the literature comes out of electricity. There is some literature on jump processes and spikes in FX, but not nearly so much. Not surprisingly, given that electricity always has evidence of these spikes, whereas in FX it's only a few currency pairs which show this behaviour which requires Sparky models. Two approaches, and I talked about them in the introduction, tend to be used: the reduced form models and the structural models. The reduced form models basically presume that we have some stochastic asset dynamics, and the stochastic asset dynamics are written down and postulated in a way that captures observed market features, whereas in contrast the structural models take advantage of the available supply and demand information. So for reduced form models, and I thought it was about time I get to some equations, but I don't want to get too bogged down in pure technical mathematics here. If you start with this Lucius-Schwarz model, one-factor log spot model for commodities, which is quite popular, what this does is it allows us to fit a certain amount of seasonality on top of a process Y. So I'm saying that I've got log spot, which is described by a mean reverting process plus a deterministic correction, which allows us to fit a certain amount of seasonality. This is quite useful for those commodities which tend to be seasonal, such as natural gas and gasoline, and electricity as well. So what we have here is we have this process here which mean reverts back towards zero with a certain amount of volatility, sigma, driving this process for Y. Then what I do is I allow the base level for F, which is a function of time going forward, to allow us to shift it up and down depending on where we are in the course of a year, or possibly even in the course of a day. If we have seasonal effects attached to peak and off-peak electricity, you can have a number of different seasonal effects superimposed on each other. And then we can, given this, we have log spot, and we can infer the spot price process, which we map to the day-ahead prices for electricity. If you crunch the analysis, if you just get the Ito toolbox out, then what I can do is I can just say that if spot is going to be equal to exponential of this quantity x, where x is just defined as log spot, then what I can do is, if I write f of x as e to the x and take first and second derivatives, which are of course nothing more than just e to the x in all cases, then I can write a process for dst, and I have dst equals st times dxt plus a half times this quadratic variation term, and I can then take this log spot term and I can express as the sum of the deterministic correction plus this y term here being the term that's a mean reverting process which mean reverts to a level of zero, and I can write dst on st equals this quantity here, which I can then write out in terms of dyt squared, and the first derivative of this deterministic function f. And what that means is that I already know this process for dyt, so what I can do is I can basically plug in dyt into here, so I've got dyt is that dt and sigma dw term, so those two go in there, and if I know dyt, I know dyt squared, and it's just going to be sigma squared dt, so I've then got a half dyt squared, and that's sigma squared dt, so I then put this guy together with that guy, and then I've got a way to write dst on st, and I've got a certain amount of a drift here and a certain amount of volatility, which means that if I just do a little bit of playing around with symbols, I can write dst in terms of a mean reverting process here, where the mean reversion is governed by the difference between log of spot and this function b, which I can write down here, and then a certain amount of driving Brownian motion here. So it's a bit like a geometric Brownian motion, but with a different type of mean reversion. So this Lucius-Schwarz model, you can basically take it and then you can write it in this form here. This is quite useful in commodities, but it has two major shortcomings, which is why people use this as a starting point and then build on it in terms of building electricity models. The main shortcomings are that the changes in spot and the changes in the forward are perfectly correlated, which is unrealistic for commodities. We tend to see high levels of correlation, certainly not one though. You have a certain amount of decorrelation, which gets higher in the short end. This motivates some of the market traded instruments like spread options, for example, which are very sensitive indeed to this correlation. So if you mismark the correlation, then you'll be completely mispricing the spread options. And if you go to any of the big exchanges in commodities, like anything on the CME, for example, you'll see a lot of calendar spread options listed, and those are very sensitive to the correlation between different contracts on the forward curve. That's your first shortcoming. The second shortcoming is that this model here because it's purely written with respect to a drift and volatility, it doesn't have any evidence, any ability to generate spikes. So why did I describe it? Because people tend to build on this model here in the reduced form approach to introduce spiky behaviour by taking, for example, a mean reverting process for dyt, which is this term here by itself is from the Lucas-Schwartz model, and then we can add a jump process into that here, where we've got a jump distribution which has a certain mean and a certain dispersion in the event of a jump, together with a Poisson process which describes the frequency of jump events as they come in. Now, if you look at a jump diffusion model like that, then what you have is a model that's really well suited to describing something like that, for example, where I've got a process here, and then I've got a jump, and then I've got a new regime, and it's pretty good for describing this kind of asset as well, dollar Turkish, where you've got a jump like that, but it's not going to be so good for describing anything like this, sorry, wrong slide, anything like this, where once I have a jump I need it to come back. So that's something that you need to build into the modelling effort, which is actually quite tricky, because even though the jump diffusion model is quite well suited to pegged and quasi-pegged FX, which I showed you the charts for earlier, which after a deval event may well stay in the new regime. For electricity, if I have a spot price process or a day-ahead price process which goes along, spikes up and then spikes down, when you think about it, that's completely non-Markovian, because it has to remember where it came from. So there's quite a lot of interesting work that's been done by some people like Valery Kolodny on trying to build non-Markovian models. Yes?
For pegged FX currencies, you say it works quite well, but the volatility changes just as much as the value changes. But in the model you described, I don't see where the volatility also changes.
Yeah, that's right. So in this case here, this is a simple model, obviously, so people would need to extend upon this to allow the volatility to change in the event of a state transition. That's actually much easier to put into the second class of reduced form models, which are the regime switching models, because when you go from one regime into another, then the volatility can change once you move from regime to regime. So that's actually a good reason, it's actually a nice transition into the next piece of the talk. You can, of course, allow this volatility here, this sigma, to depend in some way on the asset price level. I could allow it to be state dependent, so that if the asset price is high, then the volatility is high. But that's a bit of a kludge, to be honest. Anyway, I should just finish the Poisson process part. So if I'm just building a jump diffusion model, then I'd have this mean reverting term for y together with the jump process here, where n would be a Poisson process, which I've just done a visual simulation where I can show different possible path trajectories for a Poisson process. This one has intensity parameter 4, I think, so you can see they all start at 0, and then you have increments, integral increments at various random times, where the distribution of the Poisson times is governed by an exponential distribution. This one here in red is just one particular instance of a Poisson trajectory, and the other ones are greyed out in a pale, insipid yellow colour. You can try to decouple the mean reversion rates for regular and jump components. I mean, there are a number of different extensions you can do. People take these models and try to improve on them. So Tino Kluge and Ben Hambley, Sam Howison and Kluge have tried to do some other work by decoupling the mean reversion rates for regular and jump components, for example. So what they've done is they said we've got this deterministic component, and then you've got these two mean reverting components, one of which is given by the sigma, so that's a certain amount of continuous volatility, and then when we have a jump process, then it mean reverts back from that jump level much more quickly. So that's actually quite good, because that says if I've got a process that moves along, then it's got a certain amount of mean reversion. But if it has a jump process, if it has a jump event, then the mean reversion is much higher after that jump. So that's quite useful for electricity, because it allows us to recover from these spike events more quickly than we would without this second mean reversion. This tends to be at least an order of magnitude bigger, sometimes close to about 30 or 50, I think is what they regard as sensible in their paper. You can also do a second residual Brownian motion, so where you've got this Brownian motion here for the first component, and the second component is purely a Poisson jump diffusion, without the diffusion actually, it's purely jump process on top of a drift. You can also allow this dy2 to have a dw term in here as well, so that's what you see here which is described in this paper by Villaplana from 2003. So you can extend the models in a number of different ways. If people are interested in academic research in commodities, electricity is a great asset class to be in, because you can see, and you'll see also a reference list at the back, there's a lot of quite up-to-date academic literature and a lot of very open questions. So I described the first reduced form model, the first class of reduced form models, which were jump diffusion models, which effectively take some of the ideas that Bob Merton had in his old paper and try to tailor it to the specific needs of electricity markets. You also have these other types of reduced form models, regime switching models, which are more similar indeed to some of the uncertain volatility models you see in FX and to a lesser extent other asset classes. What these basically do is they say, let's suppose we have a certain number, a denumeral number of discrete states of the world. So you could have 2, 3, 5, 6, you could have 20 states of the world if you like. In practice, you don't need anywhere near that many. 2, 3, possibly 5, even 5 is probably too many. You can imagine that you might have 2 different states corresponding to no devaluation and devaluation, for example. Or you could have 3 different states corresponding to high, medium and low states of the world in a risk kind of volatility modelling environment. 2 is sufficient to describe a certain amount of skew. 3 is sufficient to describe a volatility smile when you think about the degrees of freedom attached to building volatility surfaces. I challenge anyone to see any regime switching models that need more than 3 different states of the world when you actually pare it down to the basics. But what sort of regimes are they? I mean, you can basically come up with 2 different sorts of regime switching models. You can either allow the parameters themselves to switch, and that basically means that I can write a single SDE, something like this, but the parameters are chosen from a set of 2 or 3 or 5 different values. So this would mean, for example, I've got a certain drift in regime 1, a drift in regime 2, a drift in regime 3. If my L here is 3, if I've got 3 different regimes, capital L is 3, and then I've got 3 different possibilities for the drift function, and perhaps more practically, 3 different values for the volatility function. So this could be used to allow a vol to be in a low, medium and a high state, depending on whether we're in state 1, 2 or 3 of the world. But the actual SDE itself, when I write it out, is exactly the same. It's just with a different choice of parameters, sampled from somewhere in this set of possible regimes. In contrast, independent regimes, which have a lot more flexibility, allow us to have completely different either processes or even random variables in each of these regimes. So I could say that at a particular time t, as I move forward in physical time, my regime can still be in states 1, 2 or 3 if my capital L is 3, but if I'm in regime 1, then I could describe yt by something yt1, which might be an equation like this, or it might be a constant, like you saw in $CNY, or it might be a random variable. So you have a lot more freedom when it comes to constructing different constituent regimes in the independent regime approach than you do if you have parameter switching. I mean, you can reduce this to that by just saying I've got dyt equals this times indicator function, and with enough indicator functions you can do pretty much anything. But in that case, you're basically trying to make this model look like that. The whole point about parameter switching models is that you have a particular process and then you just tune the model parameters depending on which regime you're in. But the independent regime models say maybe in some regimes it's appropriate to use a jump diffusion model, maybe in other regimes it's appropriate to just say I've got a certain spike level and that's a random variable, and it's completely nothing at all like a jump diffusion. And that's one of the examples I have. So if you look at, say for example, a 2 regime model which has a regular state of the world and a spike state of the world, and that was described in this paper by these guys here, then in the first regime, and this is the independent regime approach, in the first regime I have a mean reverting process for this dyt1, so yt in regime 1, mean reverts back to the level m, it's got a certain mean reversion rate, alpha, and it's driven by Brownian motion, whereas in contrast, in my second state of the world, it isn't a stochastic process, it's purely a random variable that's drawn from a distribution. which has a certain mean and a certain amount of dispersion. And then I have a Markov chain model which governs transitions between those two different states. So what that means is most of the time I'll have a jump diffusion process, diffusive process goes on like this, but every now and then I'll just go into a particular state like this and stay there until I go back into my SD world in regime 1. So, I mean, you could argue that's unrealistic, but it works reasonably well. You can have 3 regimes as well. This is something they discussed in, well, this author together with a different co-author discussed in a different paper in the same year. We have, once again, a mean reverting regime here. So that's a regular regime. We can have a spike regime, which is given by d, yt, then goes into a spike. And then once you're in a spike state, then you've got this mean reverting process with a much stronger mean reversion here, which allows us to return from the high spike level, so where this alpha 3, this mean reverting rate, is much higher than the mean reversion rate in the regular regime. And then you need to come up with transition probabilities that allow us to go from regime 1 to regime 2 and then to regime 3 with suitable intensities. It probably doesn't make too much sense to go from regime 3 directly to regime 2, or there's other transitions. You wouldn't go from regime 1 to regime 3 directly. That wouldn't really make any sense. So you have to choose these particular elements in the Markov chain transition matrix appropriately.
So a short question. Maybe.
Yeah, of course.
I mean, these are models with a lot of parameters. Is it at all possible to calibrate them in some sort of way?
Not all of them. I mean, you can certainly try. Yeah, calibration of these models it's definitely not a science. It's very heuristic. You certainly see that a lot in the commodities literature. You certainly wouldn't build any kind of calibration engine that would try to fit all of these parameters given market data. You can see from some of the earlier slides describing electricity markets, you don't have the same amount of liquidity that you would in equity or FX. So your calibration, you'd have to choose some of them based on economic fundamentals, on values that you expect to be 0, so you'd have to put in various constraints, for example, such as you'd say the transition probability from regime 1 to regime 3 would be 0 because it makes no sense to have that particular transition. Other parameters you could calibrate.
What sort of time steps would you use for your Markov chain modeling?
Oh, it's quite rapid actually. I mean, probably the thing people tend to do is they tend to have quite small time steps once you go into a spike level, because then you have to allow yourself to return from the spike. So you want to have quite a high density of time points as you recover from the spike. But then when you actually are back in a regular regime, you'd probably have coarser time steps until you actually experience a spike event. But once you get that spike event, you have to put a lot of time points in to work out what's going to happen coming back off that. If you're trying to model the entire path history of the electricity, day-ahead process, though for some of the products you probably don't need to get quite that much granularity. It depends on what you're trying to do with Monte Carlo. So I've described the two broad types of reduced form models. The other one I wanted to describe in the time available, which we're broadly on time, the structural models, which, if I was going back to economics, which was one of my less favourite subjects in the old days, but I survived it. If you look at supply and demand curves here, in a very simple fashion, what these show is the relation between price and quantity. So this basically shows that if I've got a particular demand, a particular good which has a certain demand at a particular price level, as the price goes up, the quantity demanded will come down, because as things get more expensive, more and more people are going to opt out of choosing to buy them. Whereas in contrast, as prices go up, then the quantity made available on the market in terms of supply curves increases. So this is just very simple economics. And the reason I show you that is because even though you don't often see supply and demand curves in real financial markets, you do it in electricity to some extent. Because the way that electricity is traded, because of the auction system that we have for day-ahead prices, what market participants are obliged to do is to submit their bids into the auction system for supply of electricity at particular price levels according to different factories and different production techniques. So what this chart shows is how we can effectively back out a very non-linear stepped supply curve, which I can trace out with a laser pointer along here, like that. So you can see it's an increasing function just as this one here is an increasing function, though this is completely schematic, whereas this is actually information available in the market for where various market participants are happy to supply electricity at different price levels indexed on the vertical axis. So this vertical axis is in euros per megawatt hour, which is how electricity is quoted in price terms. And the horizontal axis is effectively a certain amount of electricity. When I say amount or capacity, what this chart corresponds to on the vertical axis is effectively the amount of electricity that can be supplied into a transmission network at a particular price point, given a particular factor of production. So we have here renewable energy. So you'll see the graph, the chart for renewable electricity basically says the marginal cost of production is zero, which is vaguely sensible because the main cost by a long way of renewable energy is just building the wind farms, building the technology, but because it's renewable, once you've got the wind farm or once you've got the solar panels, they actually are able to take advantage of what is effectively free energy coming from the bounties of nature, if you like, in a way that we don't have with non-renewable energies such as nuclear power, hard coal, lignite, natural gas and heating oil in the dark blue, where once we use it, we've used it. It's not renewable. So that means that because it's not renewable, if I'm going to burn a certain amount of coal or natural gas or heating oil, I'm going to want to be compensated for it, so I'm going to charge at these particular price points for that. The prices increase as we go up from nuclear power, which is one of the cheaper forms of power, though we also notice that nuclear power and hard coal are also base load types of power. So now you're seeing evidence that, visual evidence that the base load power is generally much cheaper than mid-merit or peak load power, such as these natural gas power plants, which have power bids in the system in excess of the current price of 60 euros per megawatt hour. These ones here are bid at around 80 or in the high 70s. So in this case here, the market would basically say, right, if that was the amount demanded in the market, and I've just drawn a very inelastic vertical line for electricity demand, on the premise that electricity demand tends to be inelastic. I don't think anyone in this audience would have looked, gone to their post, opened up their electricity bill, looked at it, shrieked in horror and said, right, okay, I'm never watching TV again. People just, tend to consume electricity. The demand for electricity is much more inelastic than petrol, for example, which certainly was affected by the recession in North America, but electricity is quite inelastic for demand. Hence my vertical line, which I'm using for modelling demand in contrast with supply. So this basically says if that's the amount of demand for electricity in a market, then the market price is going to be at this point here with the intersection of this very non-linear supply curve and the imputed demand here, which means all of these power plants here on the left will be used and the ones on the right will be sitting around vacant unless they're called in to fill in the real-time market. If there's a sudden unexpected surge in demand, then in that case these peak load power plants will be called into action, and the people who are selling their electricity for $70 and $80 will be quite happy that they didn't sell it for 60. That's the way the system works. So what we can do is we can basically try to build a mathematical model based around this supply and demand analysis. What people do is what some people do is they posit these supply and demand curves. So the demand d subscript t can be written just in terms of this A and sigma 1 and yt here, and then what we can do is we can write a parametric form. I mean, probably we should actually try to take advantage of the actual information in the supply curve from the merit stack, but you can write it as a functional form. It doesn't have to be as simple as this. You can enrich the parametric description where x is the x-axis we saw on the previous slide, and what we can do is we can solve for the equilibrium price level by requiring intersection of supply and demand. Now, this yt here, this is to be understood as a stochastic process which allows this dt, this inelastic demand level, to vary. So we basically have stochastic demand, and then we have this deterministic supply. And what this does is, because this particular choice of function, it was chosen by the author so that we would have an invertible function. What we can do is we can then say if we have equality of supply and demand, then what I can do is I can say that the quantity is equal to this A0 minus y divided by B0, coming from the parameters in these two equations with an exponent, and then what we can do is we can allow this demand to be driven by a stochastic differential equation. I'd have to refer you to the paper to look at that, but what the nice thing about this approach is that given a particular very simple model for supply and stochastic, deterministic supply and stochastic demand, that leads to a non-linear Ornstein-Uhlenbeck process, but with spikes, which is something that was very notable back in the early days of modelling electricity as an asset class. So what I've done, and I can go to my conclusion slide now, what we've done is introduced features of both electricity and particular types of controlled FX markets which evidence spiky behaviour. Though we do have spikes in both asset classes, they're different, as you saw. Spikes in electricity tend to be extreme and short-lived, but very quickly return to the previous regime, whereas in FX, once we have a spike, it tends to herald a transition to a new regime. So you can see that if I was building something like a regime switching model, for example, then the regimes for FX would have to be chosen differently from the regimes in electricity. But the whole point about some of these models is they can be tuned appropriately given the particular asset you want to describe, be it FX or electricity or even equity. I would say the jump diffusive models are a good choice for FX. Not so appropriate for energy. The reason they're not so appropriate for energy is they don't allow us to have spikes which retrace back to the previous level because they're Markovian, and electricity doesn't have that simplicity. Structural models are very much electricity specific, but you certainly could, if you had an order stack or a limit order book available through brokers, for example, or if you're a large enough market participant that you can access proprietary information or exchange information attached to supply and demand, then you could certainly build similar types of structural models around any asset class. Regime switching models sort of combine advantages and disadvantages of the two other models on either side. I can certainly give some references. I'm not going to go through all of these, but there's a number of different papers and conference presentations on electricity. It's a nice asset class to look at because it's quite intricate, but there's a lot written there. So it's not one of these asset classes where you have traders or other colleagues asking you, okay, can you build a model that tries to describe this type of behaviour, and then you do a literature search and you discover that no one's written anything at all. There's quite a lot written in electricity. It's, I mean, there's other asset classes which have a surfeit of literature as well, like interest rates. I would say that electricity is an asset class that has a lot of open questions, though. I'm going to do some advertising here. So this talk was based around chapter 7 of this book here, which I hope everyone's had a chance to browse through. You already know that the books are available here if you want to buy them. And my final slide is just to describe what I'm up to at the moment. I took a sabbatical last year on account of the books and also spending a bit of time with family commitments. Now I'm back in the city. I'm doing some contracting at the moment for an exchange on matters related to FX and risk management, and I'm trying to build this out to cover not just consultancy but also contracting and training. So as well as looking for new clients, I'm also looking to build on the networks I have in terms of industry and academic partners, which is why I continue to be very happy indeed to support Thalesians in their continued success in financial markets. Been a pleasure here tonight. Do we have any questions?
Are there any questions?
Yes, I have two questions. So,
good.
Sorry. The first question about renewables.
Right.
So, like solar power
right.
and wind power. What happens if you sign a contract, but then the sun doesn't shine or the wind doesn't blow? How this situation is handled? That's my first question.
Right.
And my second question: how country-specific is the market? Because what you describe is an auction system, but I would imagine that in certain countries it's more regulated, and perhaps even in Germany it's more regulated, and maybe I think I'm not 100% sure that they might have dealt with the problem of the renewables, of the instability of the renewable energy by a piece of legislature.
Right. Yeah, those are two good questions. I'll start with the second because it's easy to describe. Yes, the different auction mechanisms differ from country to country. Where you look at L-Spot and Nord Pool and the UK, the auction systems are developed separately country by country and even region by region in the USA, for example. So there are different aspects. Not all countries have the same separation into the two different markets, the day ahead and the real-time market, but these features are certain of these features are common to most of the electricity auction markets. Obviously not all countries trade electricity on an auction basis. This is a relatively recent innovation. And as far as renewables, you don't really have so much of a direct electricity market purely for renewables. They tend to be delivered into the grid. And what end users who choose to sign up for a green electricity tariff tend to do is they tend to buy a particular tariff where the utility guarantees that a certain proportion of the electricity will be delivered through renewable production means. So generally it wouldn't be 100%, you'd have something like about 80% production or maybe 50% production from renewable technologies. So you just have to hope that the sun or the wind is available 50% of the time for that.
But does it mean that it's not possible to have utilities who only specialize in, say, wind or solar power because they have to back up their obligations by...
Yeah, exactly. And part of the reason is if you had, it would be far too risky and it wouldn't make economic sense for a utility to deal purely with solar energy, for example, because of course if it's a completely cloudy day and there's a huge surge in demand, they just can't fulfill their requirements. So much as I'm particularly in favour of environmental advances, the thing is that you can't, what would you do if you're, I come from Australia, right? So what would I do if I was a utility company in Australia and the sun was shining for 200 days of the year, but there just wasn't enough demand for power? Everything would burn out. You'd have to make sure you have consumers available to take advantage of this source of unlimited power, which actually is, I have an interesting example for you actually. A good example of a country which is an electricity producer that had exactly this problem is actually Iceland, because they have, and still have, quite a large amount of electricity production from geothermal energy, which they can't actually deliver. I mean, Iceland is a pretty small country. People don't tend to use that much electricity there. So what they actually did in order to be able to turn that electricity into something that they could get economic value out of was they decided to build a lot of aluminium smelters. So maybe you already know this. So what happens is they basically overproduce aluminium given the size of the country, but on a relatively, how do I put it, unpredictable basis, and then the aluminium gets delivered into the market. Why? Because they had all this extra electricity which they needed to use in some way, and they can't build a transmission network from a small island in the middle of the Atlantic Ocean anywhere else, so they really had no alternative but to do this to handle the unusually large amounts of electricity coming from a renewable source.
I heard that one effect of renewables is that it creates the possibility of negative electricity prices for the reason that you were talking about. That
yes.
Too much electricity gets supplied.
Right.
But I saw in a lot of your models are log normal.
Yeah, once again, there are quite a few asset classes which the models tend to presume positivity of prices. You can look at interest rates as well, but you do have the possibility of excursions into negative asset price territory, so models should take into account. You can get negative electricity prices even without renewables. The reason you tend to see them more with renewables is just because if you look at the marginal cost of production here, then I've got this particular region here where if I move to this region, then the marginal cost of production is effectively zero. So if I have a lot of electricity being made available to a network but demand collapses, then from the point of, it's basically because if I'm going back to your question, if I'm a renewables electricity producer and electricity is available to me, right, so I'm producing electricity but there isn't a demand for it, I have to find someone who's willing to consume it. And if I don't, what's my alternative? It's going to burn out my machinery, which is going to cost me a lot of money. So it's actually economically advantageous for me to pay someone to consume the electricity, which means negative prices, compared to the cost of having to repair my machinery and my electricity transmission networks in the event of catastrophic failure. So I'm trapped between two different devils, if you like, and I have to choose the least worst alternative, which means negative prices compared to catastrophic failure. But that could happen even if I was in this region here. If I was a nuclear power producer, in that case there, I could still be trapped in the same situation. In fact, probably even more likely in that case, because you can imagine if I'm a nuclear power producer and if I can't shut down my nuclear power stations quickly enough and I'm producing all this electricity, if I can't find someone to consume it, well, the costs of catastrophic failure are probably higher for a nuclear power station than someone running solar power stations or wind power. So it can happen for at least these two asset classes. For coal, probably less so. But there's nothing specific about renewables that makes it only possible to have negative power prices coming from renewables. You have to look at the costs of equipment failure in the event of demand not matching supply.
My question was about the challenges of modelling it.
Right. Okay, sure. I didn't touch upon the model's challenge when it comes to modelling negative power prices, but it would be the same type of challenges you have with interest rate modelling, where you have to look at how to deal with the possibility of negative values. You can do something using displaced diffusions, for example. If you can presume that if you have negative prices for electricity, then they don't go below a certain level, you could do something like that. That would be entirely appropriate to look at. It's not been, I haven't seen any papers on that actually, so if you're wanting to get into that area, I suspect that's something people haven't really looked into. But a good question. Mm.
Hi. So I don't know if that's still the case, but whereas it used to be in that domain, basically the action model works to the point at which basically National Grid was saying to you what's the price that you're going to be penalized at and what's the price that you need to deliver at. Because if there was not enough supply and demand, then they were driving the market. So your jump motions, they're actually reflecting these operations, aren't they? They're basically reflecting guys at National Grid shouting out that we need more power, or someone's going to penalize 500,000 because their nominations were too high. Yeah,
that's exactly right, because you have the auction system, which is set up with strong penalty clauses in the event that market participants don't agree on the already established contracts to match supply and demand.
All right. So wouldn't it be easier to just work on the assumption that this is going to happen on a stochastic basis, but you can't really go into that jam. You can't really switch into another regime. You know that this is going to be something that is going to happen from time to time. That's your risk, but you can't model it. Because usually when I experience that in real life, it happens when someone's power station goes down, someone's turbines breaks, quite unexpectedly. So you can't model that in any way. You can't build a stochastic process that's going to model something like that.
Yeah, I think I see what you're saying. I think it's part of the reason why people look at some of these reduced form models purely for asset price dynamics and try to come up with alternatives like regime switching, where you basically have a richer class of model.
Yeah, that's the thing. Even with regime switching, you are not switching to another. You are switching to another regime when someone built a new power station. And of course then your regime is switching because the supply is higher. Or a huge energy supplier is signing up a contract with another power supplier, and this contract is going to deliver their prices at lower levels. But in this situation, I think you can easily work on the assumption that your 15 minutes jump of prices is just this. It's just 15-minute jump of prices. You don't need to switch to another regime and go back.
Right, but I mean the price levels can be different for that 15 minutes then, aren't they?
Yeah, but your future is going to stay the same. Your future is not going to be affected in any way.
It depends on how long the future is, though, doesn't it? Whether it's just an hourly contract or a daily contract or a weekly contract. It depends on the granularity.
Okay.
Yeah.
So you're working on the assumption that your future price for delivery for the whole week is going to be affected by some.
I see. Well, it would depend on the product, wouldn't it? I mean, if you got, I don't see them in any great level, but if you had knockout options, for example, then even if the price isn't changed, you'd have to take into account the knockout feature if you were trying to do a knockout contract on electricity. So it depends on the contract and on the granularity that you need to model.
Okay.
But I agree, if you're pricing a yearly forward, for example, in that case, almost certainly you don't need to model specific spikes.
All right. Well, if there are no more questions, then I'd love everyone to give Iain a round of applause. I'm sure everyone found the talk electric. I'm sorry. I just had to do that.
You've been saving that with us.
I have been. One last thing. Also, I'm doing a Thalesians quant trading survey. And if you submit entries to the survey, then I'll give you a copy of the report as well. So it's just a bit of an encouragement for people to get involved. It just has simple questions like, what do you think will do well in the next few months, carry, trend, and that type of thing. So the more responses, the better the survey will be, and you'll get a copy as well. So just drop me an email if you're interested in participating, and I'll definitely drop you a copy of the report. So thanks again. And, I don't know if everyone saw books, but there's some books here to browse, and if you want to use sign it as well. And a few flyers as well. really interesting. I really didn't know much about it. Like, I had to look at your book, but it's such a nice
Yeah, it's easy to.
Can I just take a quick picture?
Yes, of course.
And I'll tweet it so you'll get it.
No, that's good.
Do you want to hold the book?
That's good. Familiar. Actually, listening to this one, especially in this book. Yeah, one
What do you think of that? Actually, it's not. Maybe it's probably better towards the wall. I think the problem is the
I was trying to do some stuff there, and trying to start a PhD at the same time, so see how that goes. But,
yeah, I think that would be better.
That would be great. Sure, I'll send it to Werner and everyone will be very pleased. Thanks. Thanks so much. Thanks, Nick. Too much to ask you probably about it, or something, but you know, I'll bring them around. See you next time. Thanks.
Have you worked?
Yes. Yes. Yeah, I work in oil, gas, electricity, and about the primary asset classes. That's my work. Yeah. I would say that some of the more academic ones don't get as much traction in markets. I was surprised when I started working as a practitioner.